Hello, everyone, and welcome back to another episode. My name is Jordan. I'm your host and millennial investor, and today we're going over my second largest investment, which is Salesforce. Salesforce just came out with its numbers, and we're going to go over the highlighted portions of this report. We're also going to take a look at my portfolio tracker and take a look at what I have entered into my little spreadsheet here and what I think about this looks like moving forward. Do I think this is a good report, a bad report, all the stuff in between, and where I think the company is moving forward. Now, if you haven't checked me out before, my name is Jordan. I'm a millennial investor, and my growth portfolio has two main holdings, the largest one being Amazon and the smaller one being Salesforce. So Salesforce is one of two companies in this portfolio. And then we also have a dividend growth portfolio, AM1 Finance Pie, which I share in my description of my videos, which is listed right here. And we have lots of stuff, including savings accounts, credit card referrals, and all that good stuff. So check out that stuff down below if you're interested, like the 124 people that have signed up with M1 Finance so far. But other than that, guys, let's go ahead and get started and jump straight into Salesforce earnings, which came at $7.72 billion for the second quarter of fiscal year 2023 that just came out a day or two ago. Now, what's interesting is that we have a couple different things that changed this quarter compared to last quarter. The revenue guidance was guided down from what it was guided previously, so that's not good. The good news is the margin, the non-GAAP operating margin, came in at 20.4, which was maintained from what it was the previous quarter, which is why I wrote reaffirmed right here in this little red box. It was previously 20.4, and then they maintained that. And then for the first time ever, they're going to be doing $10 billion in share buybacks, which is shown right here. Now, real quick, if you want to see individual categories, I know it's easy to look at these pretty little charts, and think, wow, this is really cool seeing this grow, but it's hard to see the individual business growth. So I wrote that down in case you want to see that. We'll go through that right now. So let's go ahead and start with the first little piece of data that I wrote down here, which is first off, the quarterly revenue growth based off of this quarter for the total business was $7.72 billion or 22% growth. Marketing and commerce was $1.21 billion or 26% growth. And if you want to look at that, first off, the total revenue growth, the chart looks pretty much like this when you line it up quarter over quarter. Now, if we want to segment out just that little segment that we just talked about, which was marketing and commerce, that grew at 26%, which looks like this chart. Next up, we have service growth, which went at $1.83 billion or 14%, which looks like this chart right here. Next up after that, we have quarterly sales growth, which came in at $1.7 billion or 15% growth, which is shown right here. That looks like that. Next, we have platform and other. Now, they did do a change to this in 2022. So if they wouldn't have made that change from the acquisition of Slack, it would have came in at $2.5 billion or 33% growth. And if you want to highlight that right there, let's see, platform and other. And then we also have to add the data. So that's what this chart looks like right there. Okay. Next up, we have the services and other growth. If we take these away and we look at services and other, that growth is growing very steadily, coming in at $0.58 billion. And then last but not least, you have quarterly data growth, which is basically from the Slack acquisition, which looks like this right here, coming right at about $1 billion for basically the first time ever. Now, these are all growing quite nicely. You can see that most of them are growing anywhere from about 15 to 35%, but overall, the company grew 22% year over year for this reported quarter of the second quarter of 2023, and that's fiscal year, of course. Now, profitability. We talked about profitability all the time on this channel, and that's what's really important for this company. I think it's really interesting to look at the GAAP operating margin. I don't know why this moved over. Let's move that back to that little section right there. I'm not sure what happened, but anyways, the GAAP operating margin is basically at zero. Because what's interesting is that if you hop over to Qualtrim here, and you look at this company's net income, okay? Let's look at what they did last year in terms of their net income. If you look, you see that their net income came in at only about $1 billion whenever it decides to load up here on Qualtrim. Okay, it's not loading up on Qualtrim, so we're going to look at it through here. So if you want to look at the net income, okay, it came in at about $1.44 billion. But their free cash flow, if you see this came in significantly higher at $5.28 billion. Now, the reason why this is so much higher than the net income is because of the way this company does its reporting. It's GAAP versus non-GAAP. Notice how going back to their quarterly highlights here, the non-GAAP is 20.4%, meaning their profitability, their margins, are about 20% of all revenue that they bring in. But if you look at their net income, it's only a couple percent. Now, the reason has to do with this. See this picture right here? You take the GAAP operating margin plus amortization of purchased intangibles plus stock-based compensation, and if you factor in those non-cash transactions, it's 20.4%. So basically, think about it this way. If you're confused, if you're a new investor and you don't understand, let me help you out here. These two, which are amortization of purchased intangibles and also stock-based and compensation expense, those are both non-cash transactions, meaning they don't actually cost dollar bills. They just kind of change the accounting principles, okay? So if you want to talk about non-cash, the way that the government reported, which is GAAP operating margin, they're only projecting about 3.8% of profit, right? But if you take in their actual cash, the things that actually bring in money, like this free cash flow right here, well, if you factor that in, then this company's actually having a profitability metric of a little over 20%, which is much higher than what they've done in the past. If you see 2018 here, they did 14, 2019 they did 17, 16, 17, 18. Last year was the biggest they put up, and this year's coming in a lot higher at 20.4%, which if they do that, that'll be a 1.7% improvement over last year, which has been steadily improving year over year for this company. Now, the guidance is the one thing I want to talk about. If we go to the quarter three guidance, this is the one part that's disappointing. They're only expected to grow 14%. Now, they did have some FX, which is basically the way of saying currency impact. When exchange rates change and the dollar gets stronger, it hurts international companies like Salesforce. But they're only projected to grow 14% as of next quarter. For the full year, they're projected to grow about 17% with that big currency exchange headwind. And if you see here the GAAP and non-GAAP earnings per share, like I was talking about, that cash versus non-cash difference, that's why if you look at their GAAP earnings per share, they're only making about 40 cents. But if you look at their non-GAAP, the actual cash, they're making almost $5. It's literally like 12 times higher if you look at their actual cash in, cash out, which is really what I care about. Because if you look at all these different metrics, what really matters is what dollar bills they're bringing to the business, which is why you see example like this. Look at their cash pile. Well, the company on paper is not making hardly any profit. In 2015, 7 years ago, the company had $1 billion in cash on the balance sheet. And then as of the end of last year, they had $10.5 billion, steadily increasing. And that's while this company is growing revenue, growing its business, and buying out other companies as well. Now, obviously, there's more to it than just that. One of the main things that we always talk about is the company's opportunity moving forward, and the guidance is really important. And so if you were to tell me, Jordan, what would you rate this company's earnings out of 1 out of 10? Saying a 1 being it's an absolute disaster, you hate the company, you're selling it or shortening it, or a 10 being it's the best thing in the world, the company's going to the moon, I would give this company's earnings about a 5. The guidance came in a little weaker than I liked. 14% growth is not sustainable for me. I would like this company to hit 15% minimum, preferably in the high teens, like 18, 20%. But the full year guidance coming in at 17 is okay. I don't love it. I don't hate it. That's about average for what I expect. I would like it to be upwards of 20%, but that's not bad considering we're in a recession. And also there's that currency headwind. So if you factor in the currency, it's likely it would be closer to 18, 19% growth if you factor in that. Now, the profitability came in nice at 20.4% projected, like we had last quarter, which is really good. And then the big news, which is that share buyback. If we go over here to my portfolio tracking, my little Google Sheet spreadsheet here, and you look that I projected out that as of last quarter, let's hop over to Qualtrim here and let's look at quarterly. Right now, they have 997 million shares, which is right at about $1 billion. And I projected that between now and 2026, they would continue diluting, and right now they have about 1 billion shares, and I think that in 2026, they would have 1.2 billion. Now, I always make these estimates conservative, and I shoot for the worst case scenario intentionally, but it looks like not only is that estimate going to be off, but it looks like it's going to be significantly off. So if you take that number of 10 billion and take where the share price is at today, the share price as of today, let's go to the research tab here on M1 Finance and pull up ticker symbol CRM. The company trades at 173, finishing out down 3% off the back of this earnings today. So if you take 173, so let's take that number real quick. I want to plug that in my calculator. 10 billion divided by 174. If you were to take today's share price of 174 and use their buyback at today's share price, they would buy back 57 million shares. So take this number of 997 minus 57, that would take it down to 940. So this number of right here of 1.2 billion projected is likely going to be way off. They may not even be over $1 billion now that this company is likely going to be doing a lot of buybacks. That's good for me as a shareholder and good for other owners that own the company. But overall, what do I think about the numbers? What do I think about the business? Guys, I'm a long-term shareholder. I think that this chart will continue to go up. I think that the free cash flow, especially on an annual basis, will continue to look better and better. And if they buy back those shares, then this chart, which is free cash flow per share. That keywords is per share there, when that factors in dilution and accretion of shares. If you factor in the per share basis of free cash flow, I think that this chart is absolutely going to explode over the next couple of years. I think maybe 5 years from now, we might be looking at something like, I don't know, $10, $11 of free cash flow per share if this company continues to grow and continues to innovate. But overall, I'll continue to have it the second largest position in my portfolio, and I'll be holding this company likely for a long, long time. But thank you guys so much for watching. I appreciate you watching until the end. If you're a CRM Salesforce holder, let me know. I'd like to know down below in the comments. Check out everything down below in the description. And other than that, guys, I'll catch you guys next time.